This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
When did famous investors get so young? On this week's show, I'll try to figure out what comes next after the market takes a mulligan in honor of the PGA Championship and resets itself to zero for the year. And I'll look at a famous investment letter written by someone somehow younger than I am. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. And while it's becoming a bit more challenging to focus on individual stocks on the show as I think about the broadcast for the week, I start with the premise that the point is to summarize what's happened and what do we think will happen going forward. Sharing in the resources here that we have at hand to come to these conclusions. Because of that, it's hard from my perspective to make it very tantalizing because that narrative really, it shouldn't be changing very radically week to week. In fact, I feel like we spent the better part of, I guess, the last few years or so really just seemingly endlessly talking about the Fed and fiscal policy. And more recently, of course, we've been bogged down in the issue of the tariffs and what they may ultimately do to earnings, which is the point of all of this. I finished last year, and I keep repeating this, by projecting that we're going to start this year by experiencing the negative effects of tariffs, only to then, and when then is a question, but then afterwards get a lift from what would be the benefits of lower regulations, continued lower tax rates, freer and cheaper capital access. Well, more recently, for most of April actually, after the announcement of what JP Morgan referred to this week as draconian tariffs, it started to worry, I'll say everyone, that the enormity and scale of the tariffs may be too much for that good stuff that comes next to overcome. And now, as we move on from April, it's as if it never happened, as many of the tariffs have been delayed, some of them were reduced, others, certain sectors and industries were given waivers and so on, leading the markets to fight their way all the way back to flat, to even for the year. I mean, what a joy, right? What a great ride it's been. Now, despite what you may have read or heard elsewhere, the markets did not crash in April. But at its low point, which was April 7th, my wife's birthday, the S&P 500 was down 18% for the calendar year. It did, however, then start to rally. And by the end of the month, the market was down just 1% for the month. That was quite a rally. And as I speak today, the market, the S&P 500, is dead flat for the year, back to where it finished on December 31st. Of course, although the markets have rallied and reset the clock here, the effect of the tariffs already on the economy they're not nothing. And their threat of getting more or being applied in a greater way or bigger way is certainly not entirely removed. So where do we go from here? Well, to look at some sources here, according to Torsten Slok, who is the chief economist over at Apollo Global, he puts out a very succinct but generally well thought out daily piece. And in one of his daily missives this past week, he said that the probability of a recession in the U.S. this year is down to a 30% chance. He emphasized that, quote, looking ahead, end quote, as I'm trying to do here, the key issue will be to monitor how much confidence damage has been done and how fast can it recover. Will it happen suddenly, as the markets seem to be leading us to think right now, or is it going to take months or even years? He then went on to focus specifically on tourism here in the U.S., which I was actually surprised. I had to actually look this up and confirm, but the way he's looking at it, foreign tourism in the U.S. makes up 10% of the U.S. gross domestic product when you count and factor in the secondary economic impacts from tourists coming to the United States. Recently, tourism in the U.S. from the visitors from Canada and Europe, though, was down 30 to 40% over the same period last year. So we'll see if, maybe this summer can be saved. It's kind of like if you remember the movie Jaws, the mayor of Amity was trying to save the summer, and, Roy Scheider did not think it was going to go that well, and it didn't. Well, we'll see what happens. Over at JP Morgan, as I referred to earlier, they updated their forecasts after the, quote, dialing down of some of the more draconian tariffs placed on China, end quote, and they reduced their odds of a recession in the U.S. this year all the way down to 35%, where previously it had been over 50% before we saw this capitulation on tariffs this past week. However, JP Morgan's GDP estimate for the full year is still below 1% growth. And as I said on previous shows, a heck of a lot is made out of that R word, if we officially get a recession. But positive 0.0% growth isn't really that different as it affects the earnings of the companies we invest in than minus 0.0% growth. So, we're not seeing a lot of forecasts here calling for very robust growth, except in one area, which I'll actually double back on later on after I take a break. But moving on, Goldman Sachs also had to, kind of pull out the eraser and update their forecasts, in which they lowered their recession chances also to 35%. But the twist worth mentioning there is that while they too are backing off the worst threats that come from the trade wars, they go on to point out that, quote, under our new economic baseline, the rationale for rate cuts shifts from insurance to normalization as growth seems somewhat firmer, end quote. And without unemployment rising much and with economic conditions seemingly balanced between the risks of inflation and the risks of the economy slowing down, the urgency of rate cuts is kind of rolling out with the tide right now. And whereby Goldman Sachs had expected interest rate cuts to begin in July, the new update here, they say that they don't expect to see a rate cut until December, which is certainly more conservative than the consensus. And the sequence of cuts at this point, they expect to be more measured, not one a month after each other, but rather they think they'll spread them out by a few meetings. So where do we go from here? It's pretty tough to say. Trump is now saying he doesn't want the revenue from tariffs, quote, although some would disagree, end quote, and he's more focused on opening China to U.S. businesses. And that was a big part of what obviously made a big rally in the markets this week. The markets took off when he pivoted to that sign of this argument of, does he really want these huge tariffs, or is it all hardline negotiating tactic? Well, now it seems like it's all a negotiating tactic for the moment. And in the end, he wants U.S. businesses to be able to sell, to grab revenue from within China, rather than the imbalance that's defined that relationship for decades now. And as he said in that brief quote there are some who are selling a different case within the administration where tariffs are going to be in place. They are going to be there to force manufacturing jobs to be created back home and also to generate tons and tons of revenue for the U.S. Treasury. And that's a story that I guess kind of continues to needed to be told, because if they're going to push through the current tax proposals that also surfaced this past week, well, they're going to need to come up with these revenues or tell stories of revenues somewhere if they are going to try to, at best, keep the budget deficit currently steady. But in the end, it looks like a lot of pressure has led to a retreat here with a grasp at a few straws of declaring victory on the trade wars along the way. It's far from done, though, and the big prize, which is China, still remains to be determined, and we still have the kind of looming threat that it's on this temporary hold for now. So while I am incrementally encouraged that we will be able to move past the tariff phase into the kind of pro-business portion of the agenda, it's also my job here to be cautious. And as this rally continues, presuming it does, just in the next few weeks, there's going to be a booming feeling. You're going to see more and more, either hopefully not with yourself, but around you, the fear of missing out is going to start taking over more and more. And there's going to be, therefore, a snowballing effect, potentially dragging the market higher as we see a flood of capital from the sidelines, because people are going to think they're missing out. They panicked at the wrong time. Now they want back in. And people are going to buy things that it could ultimately carry the market to new highs. But without a similarly growing conviction that forward earnings outcomes will also be rising in a similar way to what the price of the stocks is rising, we should be careful to avoid this crowd mentality and not race too quickly into this thing. My mandate here is to operate from the position that it's better to avoid losing money than to carelessly put it at risk. And today, I'm still certainly keeping most of my head and my neck inside my shell right now. I'm going to jump off for a quick break here, but when I come back, certainly a bit of data on the economy, and then discussion of that area of the economy that is still booming. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Almost everything that lagged last year, value, international, and more defensive stocks, have held up relatively better here in 2025. Is this just a knee-jerk reaction or a more sustainable trend? Tune in every week as we discuss the latest financial trends and how to become a better informed, wise investor. Listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. While it's not what it once was, by reputation at least, I still get these shareholder letters from a lot of sources, but specifically today, I'm talking about a quarterly letter that we get from the Third Avenue Value Fund. Comes across my desk, and I really don't know anything about the fund itself anymore. This is no recommendation here to even look at the fund itself, but it has a storied history. It was the fund that was famously managed for many years by Marty Whitman, who was a very well-respected value manager and provided a good take on the markets, which is why the letter was worthwhile. Well, we lost Marty a few years ago, and the fund itself is actually a couple of managers' changes since he passed on that fund over a decade ago. But it's still something that I'll glance at, and there were a few striking lines in the letter from the end of the quarter. Mostly it was striking to me because it lamented the trouble with putting out a letter. It was originally written in late March, and then the events of Liberation Day shook up the markets and led to a decline of almost 20% as I went over. And reading it now, where the markets have fully recovered at this point, it's interesting because it was reflecting on things near the depths of the troubles, but here we are on the other side of it for the moment. Well, the letter for the quarter talks about staring into the abyss, uses that phrase, lamenting that the draft of the letter had been written before the announcements, and then admits, quote, knowing that the fluidity of the current situation may make the shelf life of this letter astonishingly short, end quote. And I bring it up today, I guess, partially to point out how crazy it is to write or to broadcast forecasts when the rules are changing so quickly. But really because I'm astonished at times where I really don't see myself as so terribly old, but I'm shocked to read this well-known letter now being written by someone who has been around in the business for a few years than myself, as he describes the, quote, global tariff was the fourth most major event during my 25-year career for which almost no living professional investor has closely analogous experience. The other three events were the September 11th terror attacks, the global financial crisis, and the COVID pandemic, end quote. So no living investor has any closely analogous experience. I mean, I'm not that much older than him, but certainly we can draw on other experiences as well as history. I mean, thank God for books, because while I was, I'll say, loosely monitoring the markets during the crash of '87, I was doing so as a high school student. But at least I can remember beyond that the crises of the '90s, the ruble crisis, which led to the long-term capital collapse and quite a shake-up in the markets. I've talked about that on the show. The collapse of the internet bubble, which then continued and was exacerbated by the September 11th attacks. But, all things that happened before this fellow's career started, I guess. So while Mr. Fine goes on and describes the kind of macroeconomic shortcomings of the tariffs, which I largely agreed with, I actually took his letter as a bit of a wake-up call for perspective here. He's not saying this specifically, and no one really would put it in print anymore to say this time is different. I kind of take that as what he was trying to say here from this letter when he says it was without any precedent. In truth, there are literal and figurative precedents, there's actual data behind the scenes that's used by the folks behind the scenes at Goldman Sachs and JP Morgan. They're not just kind of winging it when they say 35%. It might seem like that. It's not infallible, but they're actually applying a methodology using actual data based upon historic precedents. Well, maybe it is more unusual today than recent history. And what is the elevated level of unpredictability, I'll say, which leads major models needing to be updated week to week, like I was saying about these recession predictions. These types of models, what the markets are going to do for a year, what the economy, these big economic pieces, they're normally not maybe updated once in the middle of the year from where they put them out in the fourth quarter of the previous year. It's not normal to see them week to week and month to month. And the crux of all of this is that if you're paying as an investor, if you're making an investment on the thesis of a bit of earnings in the future, while it may always be one, today it's just, I guess, a bigger crapshoot than normal that whether or not those earnings will be there, that what you expect and such. The premium, therefore, that they command, because you have less confidence in what these companies are going to earn next quarter or a year from now, you should be paying less of a premium for them, not more. And that's what the markets are giving you today. While I still believe that it's at best a fluid situation with lots of opportunity to the upside, we have to have, I think, reasonably less conviction in what's going to happen over the next year, and therefore should not be commanding a higher premium to even those expectations. Where the markets are today, they're pricing that future at a higher premium than ever. So let's not sound the all clear yet. But before I sign off, I did say something about a sector of the economy that's been particularly resilient. So let me pay some lip service to that at least. Strategists shared some pretty astonishing data regarding the investment and construction spending on this AI data build-out versus all other private sector investments, so not including highways and such, but all other private construction. And while a chart doesn't do much good on a podcast, what they illustrate is that where data center construction spending had largely matched all other private construction spending in the U.S. from around 2020-ish until almost the end of 2022. And that's already a lot of money going into data centers. But what it showed that was really kind of shocking is that since November of 2022, and the demarcation line here was when ChatGPT was launched, when it went live, the spending on data centers has now blasted off to new highs such that it's now about 4 times as much money going into construction of data centers in the U.S. than all other private sector construction. And the point of this story, and I'll go on the record here, is I am a believer in the impact that AI is going to have. I'm a bit terrified of what that ultimate disruptive nature may be. But the point is that massive amounts of capital are what they say in poker, pot committed to the AI and data spend out and build out here. And Strategist goes on to demonstrate this by graphing what's happened to free cash flow of the Mag 7 companies, excluding one of them who was on the receiving end of a lot of this capital. But the other 6 have gone from a recent 50% year-over-year free cash flow growth just a few years ago to now negative 10% free cash flow growth as they're plowing all the money that's coming in, and even then some, into building out their versions of the AI, the data required behind it, the infrastructure behind it on it. There's a lot of money going there. And strategist says, quote, the key takeaway from this will be that management views the opportunity costs of missing out on the AI arms race as a greater threat than any short-term pain associated with a deterioration in profitability or cash generation, end quote. So to take from the Third Avenue letter point of view, I'd say that this is what's unprecedented because it eclipses in every respect the tech spending of the late 90s that was driving the dot-com. And I'm really not saying it is a dot-com boom bubble, but it has that same scale and then some. And with the hundreds of billions of dollars flowing that way, it's going to have some kind of economic and investment revolution that's going to unfold as the lights are starting to be turned on all this build-out over the next few years. Debate that goes on far beyond this show is that who's going to be the winners and losers. And I don't mean just on the corporate level. There's going to be winners and losers on a household level. But think about all of this if this rally continues as we roll now into the summer. The fear of missing out is going to drag a lot of investors into stocks at valuations far beyond what many of the same investors may have sold them out at just weeks earlier. The task now is just look in the mirror and consider if you know what you're buying and know what you're paying for it. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.